the U.S. had a AAA rating and just got a one-notch downgrade. So they're still considered to be very safe, very secure as a lender, as a borrower and so forth. But it is a little bit of a hit, right? It is a little bit of a negative.
Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we do our very best to make investing simple. And one of the things we're looking to do on the podcast is bring in our team. We have Corey Halliday here. So welcome, Corey.
Thank you. Excited to be here.
And we have Noah Davidson.
This is so awesome, Andy. I'm so excited to be here.
You sold that well. No, we actually enjoy, it's funny because we get together often, outside of, official presentations that we give, I guess I should say. And we talk about the markets all the time. And it's an opportunity to learn. I learned so much from you guys. And today, I got a text from Corey last week. Or was it
It was from Corey.
It was from Corey. So Corey, he says, well, the credit ratings lost. So tell us a little bit about what's going on, Corey.
Yeah, so the U.S. got a credit rating downgrade, and to put that into context, it's sort of like a personal credit score, right? Your credit worthiness. So if you pay your bills on time and all those sorts of things, and you have a 800 plus credit score. Well, the U.S. had a AAA rating and just got a one-notch downgrade. So they're still considered to be very safe, very secure as a lender, as a borrower and so forth. But it is a little bit of a hit, right? It is a little bit of a negative in terms of they went from AAA to now down just a notch.
So what I think is most interesting about it is that there's something called a Sharpe ratio. And what a Sharpe ratio does is it tells you how much reward you should expect per how much risk you're taking. So if we could measure what we think risk is and measure what we think reward is, and we put those together, Sharpe ratio tells you how aggressive you're being and what you should expect. Well, the baseline in that Sharpe ratio, not to get too jargony, is you begin with what they assume is a risk-free investment. And the risk-free investment, by and large around the world, is a U.S. Treasury.
Yeah.
They're supposed to be risk-free. So they should have a AAA rating 100% of the time, because what a credit rating does is tell you basically what are the chances that you'll get paid back.
Yep.
So how can you have a risk-free investment that isn't a AAA? Because if anything less than that AAA means there's at least some risk.
Interesting thought. Are you saying that there's some doubt?
Well, I'm not doubting. I'm just saying that the credit rating, there's Moody's, there's S&P, there's Fitch.
Well, and this isn't the first time this has happened. This happened back in, 2011?
2011 after the subprime meltdown.
And the market took that into account and kind of went on its merry way and just kind of did what it did. So it's not. I don't think it's necessarily a doom and gloom, but it is certainly something that should grab our attention, because clearly 2A plus is not the same as AAA.
Yeah.
And, if there is a doubt, well, how is that going to affect the value of bonds? Interestingly enough, it seems like the market's going a little bit risk off, like money's coming out of the markets.
Yeah.
And bonds are still rising due to demand, because that's where people historically go when they go risk off in the markets. Well, where's the flight to safety? And historically, that's been bonds. So even though they downgraded the credit rating, bonds still kind of shot up a bit.
Yeah, the bond markets rallied just a little bit. And you talked about that the original time this happened was back in 2011. And the first time this happened was a bigger shock, and the market took it as such, because I remember the markets really sold off hard for a few days there.
It was historic.
Yeah, it was historic. It was a big change. This one, the market sort of shrugged off. Like I mean, it's gone down a little bit, but that original day after, I think the markets came into the morning flat. Like they weren't even gapping on the news. And so does that mean that it doesn't matter? I wouldn't say that, but it certainly, the markets look at it as, well, this has happened once before. And does it really change anything going forward? And that's the big question mark, is what does this mean? It's not as big a deal as some countries that go from kind of we're okay to a junk status or something like that. Because they're considered, it's like your credit score going from 820 to 810 or 805. It's not that big a deal right now, but the problem becomes, well, what does this lead to? Are we going to continue to see that? Is there truly risk? Because risk-free bonds are the basis behind what every other investment builds off of, right? It's the comparison of, well, I can get 5% risk-free in a U.S. Treasury, so now I need to be compensated. If I'm going to go buy a corporate bond, well, I need to get paid 7 or 8% for this corporate bond because I can get 5% risk-free. So is it risk-free or is it not? That's the big question.
Yeah, and why does someone care about this, right?
Yeah.
That's the big question. Why are we going to have a podcast on this? Why should someone care about this? Well, first of all, it's a tremendous opportunity. As an education advocate, I'm always saying, learn. Tremendous opportunity to say, well, why is this? And what can we learn about monetary policy? So here's the thing. If U.S. government debt is now AA plus, should they charge, in other words, should they give more interest than corporate AAA? I mean, talk about that. I mean, it's kind of an interesting idea. If because traditionally, Corey's right. What the Fed does, this is one thing to understand about the Fed. When they say we're going to set the rate, and we're going to say this is going to be interest rate, it isn't like there's a mandate that everybody has to change their rates. It's just competition. It's exactly as Corey said. If the U.S. government is offering 5, right, and that's the best you can get, then why should I loan you money or at 4 or 3 if I can get it from the government at 5? So I'm going to charge someone else 6 or 7. So when you look at member banks, non-member banks, money markets, it's huge. Money markets need to have a place to put money, because if I put money in a money market as a stock investor to have money go back and forth, I expect the dollar to be $1 tomorrow. I can't wake up in the morning and see it at 96 cents or 98 cents, or I've just lost 4%, 2%. Like, I can't do that. So these guys need safe places. Well, now a money market is going to go and look at Corey.
It's one of those things where, is it risk-free or is it not? Because, like you said, I have to be compensated. These banks will not lend out money if they can park their money at the Fed and make 5%.
Why would you loan money to someone for a house 3% or a car
and
or
have
a
risk of
default?
default?
Yeah,
right.
Yeah,
and these credit rating agencies really, it's interesting. They get criticized quite a bit, and they deserve some of it, because in 2008, they were a big part of the global financial crisis. Yes. If you remember, they would take all these loans. Yeah. These were bad loans. People had interest-only loans on their mortgages and all these kind of junk loans, but they packaged them all together.
The word is a collateralized debt obligation.
Yeah.
CDOs. Packaged them together, and they said
well, they're AAA. They're AAA rated because they're all bad individually, but if we put them all together, now they're AAA rated. And of course, that ended up not being the case, and they all started to collapse. And now these banks were losing billions and billions of dollars, and that's kind of the risk that these banks are taking. Is when we give out a loan, we have risk that we don't get this money paid back to us, but we can park it at the Treasury and make X amount risk-free. It sets the whole world, the whole standard. That's the volatility aspect, is if the U.S., it's not a huge issue today, but if the U.S. were to truly lose that spot and no longer be considered risk-free, now you've got some huge problems.
And Alan Greenspan, do you remember Alan Greenspan?
Of course. How could I forget?
Yeah, what did he say?
Irrational exuberance was his number one thing that I ever remember him saying.
Yeah. Yeah. And there there's the other thing. He came on CNBC, and he was livid when in 2011. He was livid, and he said, "quote The U.S. can pay any debt it has because we can always print money to do that." Well, yes and no. See, what triggered this? Well, you have this perpetual saber rattling of Congress. And Congress, are we going to raise the debt thing? Because sure, they can print money to do it, but Congress also has to say, hey, we're going to raise the debt thing and allow the Treasury to sell the bonds. The Fed can't print money for a bond that doesn't exist, right?
Yeah.
So a person, I think it's a fascinating opportunity for education, interesting discussion, because in school we learn history and civics and the legislative branch and the executive branch, the judicial branch. But I know my kids were not taught fiscal policy and monetary policy. So Greenspan's monetary policy, oh yeah, we'll print the money. But on the fiscal side, that's Congress, that's a mess. They're going to fight and saber rattle. So maybe the risk isn't that we couldn't print money to buy a bond and to make a bond valuable, right? Well, there'll be demand for bonds because the Fed will buy them. The issue might be is can the world trust Congress? Are Democrats and Republicans so angry with each other, so hateful towards each other, that they might not come to a deal? They might shut down the government. They might not raise that debt ceiling, and people might not get paid.
Well, in the wake of the decision, about every pundit I've seen has been a bit of an apologist, saying, well, it's really just for political reasons. It's, the U.S. government's going to pay its debts, that's for sure. But it's that uncertainty that they can't come to an agreement, and that they've had that pushing the debt, raising the debt limit off till the very last minute, that has created that doubt. And that's why we're downgrading. Nothing wrong over here. Pay no attention to anything else. It's just politics as usual. And then even Janet Yellen comes out and gives a real staunch, they're wrong. They're operating off of bad data.
Yeah, but Janet Yellen, come on. I don't want to disrespect the Madam Secretary, but Janet Yellen kills me, because if you read what she had to say the week, she's Secretary of the Treasury, they're not getting a deal done. So what she's saying, if you guys don't do a deal, this is catastrophe. This is terrible. Everything's at stake. We're going to be out of money. She's going nuts.
Yeah.
Okay, once she got her debt ceiling raised, now she gets her credit rating. Oh, they're overestimating this. We can pay. We're strong. So which is it, Janet or Secretary Yellen? Which is it? Is it that it's all going to fall to pieces if the Democrats and Republicans can't get it? Oh, is it? Oh, you're Fitch. You guys are overstating the problem.
Yeah, in the U.S., when they push that debt ceiling, they go past it, and the government on a couple of occasions, they've never defaulted on debt, but they've certainly not paid their bills, right? They've had a couple of circumstances where they've had to delay payments
or
to
furlough employees
and things like that. So it's been pushed to the absolute limits a few different times, and that was part of the piece for the downgrade, was that whole idea that maybe next time they'll push this too far.
But here's the thing: Newt Gingrich shut the government down.
It's not the first time that's happened either.
Yeah, when Clinton Clinton got in office and got a little bit too excited and leaned a little bit. He learned his lesson. He
got a little too excited.
A little too far to the left there.
Is one way to put it.
Yeah, so the country was like, what are you doing? And so Newt Gingrich came with his contract with America, and Newt Gingrich was more popular than Clinton for a while. So, and then, they just fight all the freaking time. But he actually said, no, we're going to shut it down and let you live with it. And people kind of blamed Clinton. So there's political saber rattling all the time. But here's the thing. They didn't lower the credit rating when we shut it down before. Why are they lowering it now? This is astounding. I remember in 1976. That's so sad. I remember. Well, I was 10 years old, but I remember it was such a big deal because it was the bicentennial and all this stuff. We didn't have $1 trillion in debt in 1976. So think about that. That's 200 years They've been around and, haven't come close to the T number. We got 33 trillion now in debt in my lifetime, in 40 years or whatever it's been.
When they went off the gold standard, it sort of went parabolic from there.
Yes, it did.
Yeah.
Which speaks to the full faith and credit of the United States, which is really Congress. So how much faith, how much credit?
That's what fiat currency is, right?
It's faith. It's out of nothing. So by decree, right? Fiat currency is, we declare this is money. It's decreed cash, not backed by anything else other than our belief in the government.
Look, the full faith and credit. It's funny that word credit keeps coming up,
Faith and credit. So the GDP is what, 22 trillion? Is that what it is?
That's about right, yeah.
So 22 trillion. So you say, here's the machine that the United States has, right? Here's the machine that they can make money, production with, gross domestic, actually production, and you tax that number. You tax a percentage of that pie, and maybe Fitch says, look, you've got 33 trillion in debt. You've got 190, and this is astounding because I was looking at my Twitter feed, kind of saying, I don't want to repeat myself. It was like 182 on the off-balance sheet liabilities, the unfunded stuff, the promises, the health care, the Social Security. The promises for the foreseeable future was like 180-something. It's like 198 now. And probably by the time this is released, it'll be over 200. So the parabolic nature of the promises we're making and the expense and the inflation, maybe Fitch is saying, hey, maybe, I don't know.
We're on an unsustainable path.
Even the on-balance sheet debt, like I look at that from time to time, and last time I looked at it, it went up 2 trillion in that period of time, which is a little mind-boggling to me. And I think one of the biggest, kind of detachments for most people is just conceptualizing
that amount,
the size of those numbers. Because once you get past $1 million, the average, like the concept of $1 billion is so foreign. I mean, what is it like? 1 million seconds is like 11 days. 1 billion seconds is like 35 years or something like that.
Yeah.
You don't check the math. I'm probably wrong, but that's that concept. When you get up into trillions of dollars, it's just mind-boggling for people.
Yeah, it is hard to conceptualize. So what does this mean to you? What does this mean to a listener? What does it mean to you? As you invest and you see this, what does it mean to you?
Well, it's not something where I would panic and sell all investments or anything like that, but it certainly is something to be aware of and learn more about. And then an interesting byproduct of that was just this morning, they came out and downgraded 10 banks, big regionals, big money center banks. And if you notice today, there was a bigger reaction in those banks than the entire market on the U.S. debt downgrade. So the market saying, we care about this, we didn't pay that too much attention. And so these banks getting downgraded is a bigger deal. Each one of them down 3% and 4% on the day this morning as we record this. And so why does that matter? Well, for banks, that's really important because the banks obviously are lending, borrowing, doing all those sorts of things. And they're not going from AAA to AA, whatever. They're on the fringe and they're in kind of that middle ground. And every credit rating downgrade could be the difference between, to put it into consumer terms, could be from going from 750 to 700 or, 720 to 680 or whatever. So it can be a bigger deal for them in that now they're not considered as safe, as secure. They're not going to have as much business, or they're going to have to pay quite a bit more on their debt. And they can't just turn on the printing presses. So if they borrow money, and these banks borrow billions of dollars, if they borrow money and they have to pay 1% extra in interest, they got to come up with that money somewhere. And it's a significant number. So to banks, getting a debt downgrade, a credit downgrade is a much bigger deal than it is for the U.S. government because, again, they can't print their own money. They have to work for it.
So you say you're not going to panic and sell everything. Buffett was a net seller of stocks?
He was, yeah.
So Corey is a Berkshire. You own more Berkshire than I do. I don't know. Do you own Berkshire?
I don't own any.
Okay, so I own
There's
some
no dividend.
Berkshire.
Why would I own? That's my
I know.
problem with Berkshire.
I know.
Create your own.
Do you know why I own Berkshire? Because I want to ticket into the annual
Yeah.
thing in Nebraska. So, but I like Berkshire. It's kind of funny to think of them as a growth stock, but they do grow.
Yeah.
No dividend. To your point, no cash flow there. You can write calls on them. But you follow Buffett probably of the three of us. You
Closely, yeah.
Yeah. So
for sure.
Tell us about the net selling.
Yeah, so they just reported earnings this past weekend, and they were net sellers of stocks, meaning that they sold more than they bought.
But they bought.
They did buy back some of their own shares, and so that was putting some of their capital to work. But they actually slowed their own share buyback, which was interesting because they don't do. A lot of corporations do a buyback program where they just automate it. With Warren Buffett and Charlie Munger, they actually try to time their entries, which is interesting because
they buy their own company and support.
Yeah, but a lot of times they
Doesn't that
argue
create support.
But a lot of times they argue that you shouldn't try to time the market, that it's untimable, that you should just stay invested. Yet they try to time the market, which
they try to time,
which is basically saying most people can't do what we can do, but it's an education thing, isn't it?
Well, and to your point, it does create support, right?
Well, yeah.
Buffett create. I mean, you can see
clearly
Oxy.
If you want to buy something, you want it on sale.
Yeah, it's like Oxy. You can see where Buffett's buying Oxy.
Oh, yeah.
You can see that coming in. You can see where that is.
Yeah.
So Buffett has always liked, he's always liked stocks more than gold, and I think I agree because you're producing things. People are, food, clothing, shelter. It's so interesting. I did a podcast yesterday with the Stockcast with Greg Author. And it was an interesting thing because we try to address the comments people have in that vein. And those listeners are so caught up in asset class. Real estate's better than stocks. Stocks are better than gold. Gold is better than, blah, blah, blah. And they don't understand it's really about the investor rather than the
investment.
But the bigger point, I think, is that the necessities of life. I love real estate because shelter is a necessity of life. But I'll tell you, there's so many more necessities than food, clothing, shelter. We have to have energy. We have to have communication. We are technology dependent. You look at the guy under the bridge with no real estate that's living there. He's got a cell phone, I'll tell you that.
Yeah.
And he's probably trading Bitcoin.
Yeah.
Why do you think he's living under a bridge?
Yeah, he's probably trading Bitcoin. But the fact of the matter is, these products and services are needs from people. So I'm kind of like Monopoly. If you land on it, you buy it. If you buy the way Monopoly is about asset gathering, right? If you land on it, you buy it. So it's funny because Noel sees something drop, and I'm like, I want to buy that. Like I see everything.
I know it's like a conditioned response.
I know,
it's like a legit conditioned
sale.
response.
It's like a consumer that sees that. Oh, look, it's the Labor Day sale. Oh, it's the Memorial Day sale. Oh, it's the Black Friday. For me, the Black Swan is just Black Friday. I get so excited to buy everything I see.
For sure.
But for Buffett to slow down and keep his dry powder, it isn't that he doesn't believe in stocks. He just thinks, okay, there's going to be more value in these.
It's interesting. In fact, when you talk about we don't want to be doom and gloom, a real simple way to reframe that is, I kind of hope the market reacts a bit.
I
kind of hope things come down because that would be an ideal opportunity
it's so much more
to pick
fun to
things
buy.
up.
It's so much more fun to buy when there's so awesome. And the VIX, there's this old saying that says when the VIX is low, it's time to go. And not to get off topic too much, but I thought, okay, Buffett, he absolutely believes what he says when he said, I will tell you how to become rich. Close the doors. When people are fearful, be greedy. And when people are greedy, be fearful. Right now there's greed, and he's fearful, and he wants cash so he can just
Yeah.
So back to credit, back to this. So I asked Corey what it meant to you as far as the credit downgrade, Noah, in your investing, in you're probably more actively trading than I do.
Yeah.
but tell me what that means.
Well,
Do you care?
Yeah, I do care because it's just that overall assessment of risk. And one of the things we talk about is like, the everything bubble. It's like you give the analogy of the balloon, expanding, and the question is it's what pin is going to pop it.
Yes.
And so, is this the pin that's going to pop the balloon? Is this the chink in the armor? Maybe, maybe not. Probably not. And the market, can certainly maintain a bullish, kind of irrational exuberance. I can't, for the life of me, make heads or tails out of the fundamentals of the market, but I can watch the behavioral patterns. And so I don't try to predict things, but I do watch. And when I see a shift in sentiment, the chart changes. And that chart change gives me actionable points. And so I'll maybe sell calls to offset some of the downside risk, or I'll look to maybe pick up insurance on individual assets, or even a portfolio insurance to hedge the downside risk. And there's a lot to be said for Warren Buffett being a net seller. They're not busy accruing because maybe they think the better buying opportunities down the road. Maybe they're putting money again back into their own repurchase program. But I would approach it in not unsimilar way. It's just kind of risk on, risk off. And right now the market's coming off of a really strong trend. And I think it's kind of hitting the pause button for a moment, kind of like are we still bullish? And the market, I don't think knows. There is no way the market knows this because it's just reacting to the reactions. So it's very reactionary. And I don't have to predict. I just have to watch the behavioral patterns.
So I'll tell you what it means to me. I am fascinated with the, I'm trying to search for the right word, the disconnection between the corporate fundamentals that we see and the sovereign fundamentals that we see. Because if you look, and it's all about the ability to print money. I mean, the sovereign fundamentals get a pass because they can print. And so there's a detachment. That was the word I was looking for. There seems to be a detachment. The earnings have been good, or I should better than I thought they would be in this time.
Yeah.
With all the inflation, you can't find a place to park when you go to the mall. I mean, it doesn't look like recession out there. Inflation's there because people are still paying it. We have not seen any deflation. I don't think we're going to. I don't think we're going to go back to those prices. There's too much money printed. But when you see the downgrade, when Fitch downgrades it, and maybe others will too, to me, it just really tells me that finally someone's saying this is unsustainable. The CBO, the Congressional Budget Office, the GAO, the Government Accountability Office, and Janet Yellen's office, the Treasury, all three of those reports, will tell you the fiscal path is unsustainable. How much runway do we have? Well, Fitch might say less than we had a year ago, right? With the nature of this off-balance sheet, or what you might call unfunded liability problem. And that will eventually leak into the Main Street economy. It will leak into the individual's pocketbook. The inflation will cause people to be able to buy less, and that will be a drag on the economy, I think.
Yeah, and the Fed had a free pass when interest rates were around zero, right? Because you're paying no interest on your debt, so why
buy
not
a house?
Yeah,
buy cars.
Yeah, if you pay no interest or little to no interest with interest rates near zero, I mean, you had 30-year Treasury bonds yielding 1%. In some countries, interest rates went negative, which is bizarre, right? Yeah. So basically, they were getting paid to borrow.
That's an interesting concept in and of itself. A negative interest rate, which means it penalizes people who save.
Yeah.
And so it encourages spending. That's the whole point of a negative interest rate, is to keep money out of savings and into currency and flowing, like transactions.
The problem is that these governments said, well, we're paying nothing in interest rates. Why not rack up all this debt? Well, now in the span of a year, interest rates have skyrocketed. Yeah. We've seen a greater increase in the last year than ever before in history, from a zero bound up to 5.5, and in some countries a lot higher than that. So now we're in a situation where those same governments have piled up trillions of dollars of debt, And now they're paying some real interest on that, which means hundreds of billions or even trillions.
I think it was $487 trillion is going to be our interest payment this year. Or billion.
Not
$487 billion.
So half a trillion.
You can cure cancer with that kind of money.
Yeah.
You could put that in research. You could cure cancer.
And that's just what you're paying on the interest. You're not even hitting the principal that you owe. You're just paying the interest at that number. And that's the problem. And that's why it's really unsustainable is we have to, the market, I think, the stock market keeps thinking that the Fed's going to backtrack and they're going to start cutting rates dramatically and they're going to start printing more money. There might come a point where they're cutting rates, but I think they're going to have to take a step back from the money printing and the debt accrual. I mean, are we in a Ponzi scheme? What is the definition of a Ponzi? You just start taking
borrowing new money to
pay old money, and that's kind of
new obligations to take care of old obligations.
Well, and if you think about, the levers that they can pull with, they can raise and lower interest rates, they can print money, they can destroy currency, and the intention of raising rates is to bring prices down, right? Well, we've seen asset prices continuing to rise simultaneously with the interest rates. Eventually, their intended purpose of raising the rates will slow that down, and I think there's some artificial mechanisms right now that are keeping the asset prices, like real estate prices, haven't really come down. But that's not because the demand is so high. It's because the inventory is so low. Because everybody who's got a great rate, they're not moving, they're not selling, they're not. No. So there's no inventory. So builders are still building, et cetera, et cetera. So eventually that'll catch up. And so again, being prepared for that, knowing what to do and how to do it is, I think, how we protect ourselves.
Well, that brings to the education piece. This is fascinating because Corey, you were a risk manager, you were an option principal. There are things you can do, but in a big, like if the everything bubble pops, which eventually it will, are we all agreeing with that? Am I a conspiracy theorist if I say that?
Well, definitely.
Is there a soft landing to the everything bubble?
I think asset prices are going to come down. It's a question of when and how big is the magnitude, or is it going to be, so just in the last, well, I guess it's 23 years, we've had the stock market go down by 50% a couple of times.
Yeah.
So a 50% drop again, certainly not out of the question. We've seen that a couple of times in the last couple of decades. So, that's a huge move. That's
half the market.
And a lot of people find that thought terrifying. I personally kind of find it somewhat exhilarating just to think about that potential.
Well, that's a plug for stocks over other asset classes. Now, you talked about that there's not one that's better than the other.
Right.
But one thing that the stock market does is it gives you the ability to make money as markets go lower.
Yeah.
You can't really do that in real estate and these other markets.
It's just tougher because it's not as liquid.
Right. And here you can short stocks, you can buy puts, you can do things not only for protection, but to actually make some money while things are going lower.
That's back to my point is you can look at a crash opportunistically in two ways. You can, you could get some long puts, you could short stock, you could get all excited about the move of it. You go out and you use something like the S&P, maybe the futures, 50-to-1 leverage, and you just go nuts and, you just get all excited. So when you were exhilarated, I thought you were going to use the word stimulated.
Stimulated, well, that's another.
Way back to the Clinton.
That's another topic anyway.
There you go.
But it's exciting.
But here's the other thing. The other way to look at this is from one of hedging and protection, which would be more my inclination than try to exploit this. I think where I am in my, wealth blueprint, I really wouldn't look at it opportunistically because you don't really know how, like you say, how far, how deep, when does it recover, what's the bounce, all that. But I'll tell you one thing I would look at is if an S&P dives quickly below its 200-day, I definitely want to be defensive with some of those things. And this is the education piece where you said learn and know. Does the average 401k guy know how to do that? Absolutely not. He or she does not. Those are strategies and tactics that are not used very often. and they're not practiced very often, and they're not learned very often, but you would have to be ready. I mean, when you look at Homeland Security or any of those FEMA, any of those departments, the Red Cross, first responders, they have procedures, emergency procedures that they drill on and they practice. I don't know that investors are prepared to defend themselves or be opportunistic. So as an option principle, let's say you're managing, you've got 200 traders on the floor, option traders, and you're looking at the aggregate risk of that. What would be your defensive moves if you saw things falling apart this way? I mean, how would you look at that?
Yeah, the first thing would be to mitigate the downside, put a limit to how much it can go down, right? And that's where that protection comes in.
And for those that don't know what we're talking about, well, how do you do that? Well, options give you choices and promises.
Yep.
And much like an insurance policy, you can get a risk graph, and you could even beta weight the whole, which was probably what you would do, is beta weight the whole thing. You say, look, we got to have a floor, and you can do this. You say, look, there's a floor where this is our max loss. We're not losing any more than this.
Yeah. So now if the market goes down 30%, your portfolio maxes out at a loss of 10%, let's say.
Yeah. I like what we would call, this is getting jargony, I got to be careful. If my mentor, Robert Kiyosaki, he'd slap me, say, quit going down these things, jargon and too detailed, stay big picture. What's delta neutral? What does it mean to be delta neutral?
It means you're neither bullish nor bearish. You have a neutral posture based on your risk profile.
That's what I like in those times, is to just put it on ice and acid, wait for things to stabilize, and don't try to trade the crazy stuff, but have some dry powder on the side that when it does dip, I mean, I didn't get the bottom in Dow. I didn't get the bottom in Exxon. I didn't get the bottom, in a lot of the airlines that I bought.
And you didn't need to.
I didn't need, that's the point. I didn't know where the bottom was, but once I saw value there, I was like, okay, I can't. Okay, maybe it goes lower, but man, where it is right now, this is a bargain.
Like I remember really specifically after the crash of 2008 when, the Oracle of Omaha, Warren Buffett, comes out and makes a press announcement. I have just bought GE.
Yeah.
Well, it's not hard to be an Oracle when you tell everybody what you bought and they go, he's smart, maybe I should buy too. And then it just runs prices back up. But he kind of put in the bottom. It was like $6 a share. And I don't know, it's trading like $130 a share right now. Like just crushed that investment over the course of a little over a decade. But that's the wherewithal. He saw value. He didn't predict the bottom. He kind of caused the bottom because he said now's the time to buy. And that gave everybody else the okay to be like, oh, well, Warren Buffett's going in the water. Maybe it's safe.
You mentioned sentiment.
Yeah.
That's a sentiment shift, right? Yeah. Is people basically say, I'm afraid to go in until the bottom's in. And so they're looking for cues. And that's where technicals come in. That's where you can see those sentiment shifts and you can see it in the chart. Okay, we've established a floor here. Now I've got something to at least bet against. So if it breaks this floor, I can get out. But if it holds that floor, I know I've got a good floor underneath me.
But even beyond technicals, back to, fundamentally, this is where I look at Warren Buffett as being so special, because if you look at the great American companies, Coca-Cola, Apple, I mean, how many of us wish the genius of Buffett is that I've never, maybe you'd know this, but I've never seen him as an entrepreneur create any company. But look at this. Thomas Edison is a pretty good entrepreneur, inventor in American history.
Better entrepreneur than inventor.
And and he has this company called GE. Now, how do you ever get that unmonopolized from him? Buffett gets it. Coca-Cola is an astounding brand. It's probably number 2 in the world next to Apple. It's an astounding brand, and look how much of that he gets, right?
Oh, yeah.
How does he wind up owning Duracell, Fruit of the Loom, all these companies, and he didn't start any of them?
No.
And that's the thing that
He
kills
didn't even
me.
start Berkshire. It was
No,
a textile company
he-
that he bought that ended up going under.
No,
you know,
no,
and-
well,
and
let's
so forth.
Well, he
just
just kind of restructured the shell.
well,
Yeah,
let's just
right?
tell the truth. They pissed him off,
Yeah.
and he bought him so he could fire their ass.
Yeah.
Isn't that what happened?
Yeah. Well, yeah, he talks about that it
You
was
know,
a big mistake from an investing standpoint.
He got emotional for once
Yeah.
and said, these guys tried to, and it was like back then it was fractional. They tried to screw him out of like 5/8 or some
Yeah.
small thing. It pissed him off. Or I can't
Yeah.
remember the story, but I know it was spite.
Yeah.
And so he didn't want Berkshire Hathaway. It was a textile company, but he
Yeah.
bought him because he
But to
fired everyone after he owned it, right?
Yeah,
Or
and,
something
and
like
that's
that.
perfectly to your point that he didn't start any of those businesses.
Nothing.
He didn't start Geico. He didn't start American Express and all these businesses
Coke,
that he owns.
Duracell,
Coke and
RC
Apple.
Willey,
Apple's
Apple.
their biggest
He owns
investment.
5% of that company, I
Yeah.
think.
Yeah.
Doesn't he own 5% of Apple?
Something like that.
So
It's
Steve
huge.
Jobs is one of the greatest entrepreneurs, ever, and Buffett's just like, whoosh, whoosh. He's just he's amazing.
You could
Yeah.
say he recognizes talent and value. That's
Well,
Yeah.
but he doesn't look at the darn price as much as he looks at the company.
the value, yeah.
And he says, okay, this price is good for
Well,
this
and I
company.
think
I'm
that's
buying
my
them.
favorite. I don't even know if it's attributed to Warren Buffett, but price is what you pay, value is what you get.
Yeah.
So
I
you're
think
looking
we
for
said
value.
that.
Yeah, it sounds better coming from you.
I think
right?
that's.
yeah.
I think
It's
we
the Cash
said
Flow
that.
Academy.
Yeah,
saying.
for sure.
No, price is what you pay. Value is what you
Yeah.
get, and he's a value type of guy.
Well, and he's a great promoter. If you watch the annual meetings, they're
He's
touting all the
fantastic.
See's candy and
Oh,
everything that
come
they
shop.
own. They're trying to sell it to.
He's playing his ukulele.
Yeah, I mean they definitely promote their stuff,
Jingles.
and so it works.
So back to our topic of the debt or the credit rating reduction.
Yeah.
Why was it Moody's or S&P that did the downgrade in 11?
S&P
Does.
did that. Moody's kind of
S&P
got in the loss of their own credit rating, so to speak,
their own.
with the subprime mortgage
Yeah,
packaging deal.
they
They kind
really
of
did
sold their services.
They lost some credibility of their credit
yes.
rating agency. But
So interesting side story that happened on, I think it was August 5th, 2011. One of my best friends growing up died on August 6th, 2011. Jason Workman, you can Google him. He was a Navy SEAL Team 6.
Okay.
And they got shot down and they were going in a rescue mission. And this was just after SEAL Team 6 had taken out Osama bin Laden a year or two or whatever earlier. And so going to the funeral, this was all at that same time. It was kind of a rough time, but going to that funeral was crazy because they were worried about terrorist actions at them. So they had checkpoints and you had to get searched to go into the funeral and all sorts of things.
That is an interesting side story. You had not told me that before.
Yeah.
I did not know that.
That was one of my best friends growing up, and that was the day after. So that was
Rough
a
week.
tumultuous time. Yeah.
Rough week.
And I was managing risk at the time, and the markets were going crazy. And then I had one of my best friends growing up, so it was a tough time. I'll always remember that time period being right there.
I loved the analogy of seeing a balloon in space, and then just kind of pins pointed out at different distances. Liquidity in the bond market. Whatever you want to. Terrorism.
Yeah.
War, geopolitical stuff, inflation, monetary. There's all these little pins. COVID, stuff like that. Which one can kind of trigger that, be that catalyst as the balloon grows? Which pin does it run into?
Well, and it's always hard to kind of pinpoint the exact catalyst. Like in 2008, we had a very specific failure of institutions. But you look at the recent failure of SVB,
Silicon Valley.
That was bigger than the Lehman Brothers. That was bigger.
Isn't that interesting?
More money involved.
Yeah.
Interesting.
So,
and that hasn't caused a cascade yet. So that's.
I think the difference, though, was in the assets that were causing the problem. And the assets that caused the problem for SVB were treasuries, were U.S. debt, where they had a mark-to-market loss, but everybody agreed that those assets were still good. Because if you held to maturity, you're confident the U.S. government's going to pay you back, right? So it fits right with this discussion.
So it was a liquidity issue.
It was
so
a
to
liquidity
speak,
issue
not-
because if they're forced
Yeah.
to sell those assets to come up with money to pay back the depositors of the bank, well, now they're taking a loss because interest rates have gone up quite significantly. So it was mark-to-market losses. And oh, by the way, there's a lot of other banks that have mark-to-market losses to the tune of billions of
Yes.
dollars.
Well,
so if people ran on those banks, they'd have to sell those treasuries, and it could take them under.
We now have, but Yellen and those guys got together. They should have done it retroactively because by Sunday, that was SVB goes down on a Friday, I think.
Yeah.
And by Sunday, the Fed they have all these backstops and will guarantee banks because they didn't want it to be a catalyst. They didn't want that contagion. It's like the emperor's new clothes, though. We got a seat here for Warren Mosler if he wants to come join us. You know, we'll fly you out, Warren. I think I could learn from him, even though I vehemently disagree with him. But for those who don't know who Warren is, a lot of people credit him as being, the father of modern monetary theory, which I don't know why it's modern, because to me it's just kind of Keynesian economics. But
yeah, it's not old. It's not.
it
new,
doesn't
it's old.
seem,
It's
it
been done
seems
before.
old to me, but it's kind of a new word. Well, now we don't have UFOs, we have UABs. It's like, what are you talking about? It's the same thing, right? But I would like to talk to Warren Mosler because he makes some points. Look, I think it was Spain. I think there were bonds from Spain that he was trading. And he made a really good move once where he said, look, they'll print money. He was like Greenspan. He says, why are we we shouldn't be worried about Spain defaulting on these bonds because we can print money. I don't know if this was, I'm sure this was pre-Euro that he was doing this. I would imagine.
It
must
could have been, but it would be a
either
little
way,
tricky with the euro because now
it's
all those
you got
countries
19 or 20 countries, 19 countries, so
share.
they share the monetary policy, and
Yeah.
that's why Greece and Germany are so different. Because Germany has a GDP, Greece is just a mess.
Yeah, they don't pay taxes.
So it could have been before that. But his point is we can have faith because they can print.
Yeah,
And as I look at the astounding weight and growth of this debt, maybe the whole world is like the emperor with new clothes. We're like, well, it doesn't really matter that the clothes aren't there. This is the policy we have, and I don't want to look stupid, and I don't want to say, hey, he's naked, because then I'm unintelligent.
yeah.
If everyone buys in long enough, maybe that's why we have soft landings. Maybe that's why the market says, we don't care. They'll print money to fix it.
Well, it'll work until it doesn't. And that's, I think, the big thing kind of brewing in the back of everybody's mind is, well, what if this time it does? We've seen hyperinflation happen in other parts of the world. And I think that comes down to a lack of confidence in the printing that they're doing. And so they print until a certain point it works, and then all of a sudden that confidence is lost. And then boom.
It's hindsight. Okay, let's say the big bubble popped tomorrow. Well, in hindsight, we just said, yeah, we all saw it coming. Like, is this hard to see?
It's not hard to see that. What it's hard to see is when.
Sure.
That's where the genius is. Like, they make movies about the guy who predicted the last bubble.
But that's,
And
then
then
let's talk
that
about
same
that.
guy keeps trying to predict
Trying to
new
predict
ones.
it, and he's been wrong every time.
Exactly.
Look, it's kind of funny because you look at The Big Short is what we're talking
Yes.
about.
Yeah.
Right? We're talking about The Big Short. We're talking about Christian Bale.
Michael
How
Burger.
many guys were saying that before, and how many guys that thought, and because he happened to be the guy that got it right, he's the one that looked like the genius.
And,
right?
and by the way, he got it wrong.
He was
but
dying.
because he was so stern and basically had the proper legal authority to stay in the position because they were trying to take him out, right?
Yeah.
So he would have made a catastrophic mistake. His fund would have blown up.
It would have blown another month, and it would have blown up anyway, right?
So he was really very wrong in his timing.
timing.
But because he was so convicted and stayed the course, and the investors didn't have the legal authority to force him out, he ended up making a ton of money and then kicked them out.
How
Right?
about the scene where he's on his drums?
Yeah.
So guess what I did Sunday? I think it was Sunday. My son says, like, I was a drummer in another life.
Yeah.
And in my younger life, right? I'm all the old hairband stuff.
This was one of
Dream
my great
Theater.
memories of our live forum. Was a drumming thing
Yeah,
that
I've
you
tried-
and the song
yeah,
came
we
on,
broke
and
into
you guys
Tom
started.
Sawyer.
Da-na-na-na. So
When
anyway,
they started
my
going
son,
to town. It was pretty
my
good.
son pulled my drums out. I'm just not I don't have the speed that I used to. You know, it's like the same as basketball. You lose it if you don't do it.
Yeah.
So I pulled my drums out, and I was down there pounding. I had my headphones on, and I'm pounding away. I thought, it's kind of like Christian Bale.
So did you pull out your phone and buy some puts?
Just
I mean, what did you do?
yeah. Just,
You start looking up credit default swaps and getting into that market.
I'm pounding the drums, thinking, man, I'm kind of like Christian Bale. I mean, I used to just visualize myself as like Neil Peart or, said John Bonham, but now I'm Christian Bale on the.
Yeah.
But that's the thing. Why would people not get educated on how to get delta neutral? Like, if you can get delta neutral and you understand how to beta weight that, maybe with an it would be pretty simple to do with S&P futures to get that and just say, look, until the dust settles, I'm just going to sit out.
Yep.
I'll have some cash on the side. When it dips down and there's value there, I'm like, okay, great. Because a bubble bursting, let's look at the Great Depression. My grandparents were in it. They taught me about it. I don't know if your grandparents talked about it.
For sure.
But my grandparents, my dad's dad, I mean, they got to the point where they'd get dandelions and pick them and eat them. They were eating dandelion stew, right?
Yeah.
Rough stuff, going out and trying to shoot rabbits and stuff.
My grandpa raised rabbits, and my dad, to this day, like I tricked him the other day. I actually served him a little bit of rabbit in a paella I made.
Oh my god!
But he swore up and down that he could never touch the stuff because he had been raised on it.
That
after
just
the
tells you what
Depression,
kind of person Noah is.
Oh, yeah.
Slide a little rabbit into it, guys.
It tastes like chicken, but but no, like that was an interesting thing about the Depression is people got along because they had gardens and they had local.
We don't have that
food. We
now.
don't have that now.
Yeah. So my wife, she grew up on a farm and they had animals, and she's just like no animals. My sons have wanted animals their whole life, so finally we got a koi pond put in, and we have koi in the koi pond.
They are cool. Very cool.
But to your point, they got through it.
Yeah.
Like, did Coca-Cola survive the Great Depression? Did GE survive the Great Depression? I don't know. It'd be interesting to see what car companies were around or not or whatever. And so it isn't like it's the end of the world. And I think that's really important. The bubble pop is not, and there were people that lived very well during those times. Just most people got.
One of the things they don't talk about with the Great Depression and the big crash of '29, that was one of the largest transfers of wealth.
Yes.
To that point in time in the history of the world, and a lot of people got really quite wealthy in the process.
And people look at like the people who decry stocks and stocks are terrible. They point to those charts and they say, well, look how long it took. They're capital gain guys. All the cash flow created in all that time made a lot of people rich, right? I mean, if you think about cash flow.
They were receiving dividends and then turning around and buying stocks on the cheap and doing those sorts of things to acquire assets.
Yeah.
And so the percentage of people is still the same problem. Maybe not quite as bad. The internet has helped that, but it's still the same problem that a small percentage of people own stocks.
When it happens, I hope it isn't like an overnight thing, because the faster it happens, the tougher it is, right? Hopefully when you look at crashes, none of them went to the bottom in one day. But I'll tell you, if you have it cross the 200-day, say, or some line in the sand, what my plan would be is to get delta neutral, not be opportunistic, sit it out, let the dust settle, and the cash that's on the side, try to find those opportunities to buy when they're cheap, rather than to be opportunistic. Now, you're going to just buy puts.
Well, I mean, there's different levels of sophistication on risk management. Like, one of the things is just start out with considering what asset class am I in. If I'm in mutual funds, am I in control? Can I liquidate quickly? I can't do that with a mutual fund as easily, but I can with an ETF. And on an ETF, I could use something as simple as a stop loss. Say, okay, if it hits this point, I'm into cash. You could, again, take it to the next level. You say, well, now I could buy a put option contract that would give me the right to sell. That could be another level of sophistication. So how sophisticated you get on your risk management kind of comes down to your education level, but you can start somewhere. You can start with the simplest of concepts and then work your way up into what's, I think a more sophisticated risk manager would be able to hold on to the asset, still keep the dividends cash flowing, and then figure out how to lower the cost base with the option.
Right. So
and also what to buy in those circumstances. A good rule of thumb is to basically avoid what is creating the problem. Like in 2008, you didn't want to be rushing into banks, even though they were going on sale. But look at the things that were getting hit in response, because it's a systemic risk, right? The market's going down, but not everything should be going down in the fashion that it is. And if you were buying Apples and you were buying other companies that really had nothing to do with the global financial crisis, but were being pulled down with everything else, well, there were some tremendous opportunities. So you can look for those companies. And I don't know what industry will be the next one that creates that effect of systemic risk. It might be U.S. government debt, since we're talking about that subject. That might be it. Look at the things that are disconnected from that, but being pulled down along with the market, because those will have a much better chance of recovery. And you'll have, they're not going to go under. They're not the ones that are going to bankrupt. Whereas if it's a systemic risk and it's credit problems, well, banks would be right in the eye of the storm again, and there could be bank runs and bank collapses and so on. So that's a very dangerous spot to play, where you can go to far less dangerous spots that are on the industrial companies or healthcare companies or things that are not associated with that problem.
What's fascinating about this is tech is that in the 90s, you have just tech, it's a juggernaut. Tech's just going. We've kind of have with AI and like tech's got a second wind kind of.
Well, and I think tech's going to weather whatever storm comes.
Right.
But in what iteration of tech?
But what's interesting is you have this drag from some sovereign fundamentals and some problems here, but you have this promising new, like you have to ride that tech. You have to, right? Or you're going to miss it. You're going to have to ride it. So it's a really interesting market. A while back, we did a series, and no one wanted, like, our management side of the Cash Flow Academy wasn't excited about it.
Yeah.
They're like, this is a snoozer. People don't care. No one's going to want this product. And I says, well, but we need it. So we did this thing on the Fed. We did a thing on monetary policy, and you mentioned the levers that they can pull. I don't know how many hours it is. It was long-winded, and it was a lot.
3-4 hour conversation.
At least.
Like
that, It was several segments. In fact, and what we did is we went through each kind of basic money supply issues, kind of history of the Fed. What is it? What's a central bank? What are the 12? All that stuff. And then we went through 6 of the top levers they have.
Yep.
Whether it be fractional reserve requirements or whatever, discount window, all the different levers they can pull. And so we're
reverse repos.
And they go, what are you going to name this? I go, well, name it how monetary policy works. And it got named like the new financial tyranny of death, or whatever it was. We named it like
they came up with a much better title.
Yeah, the destruction of the world, and it made simple or something, right? But with any program someone purchases, we give that away for free. And I will tell you that, in my opinion, that in and of itself, if a person's lost anywhere in this conversation, that course will bring them up to speed. You should understand your money. You should understand why Fitch would downgrade it intricately. You should understand that very, very well if you're a serious student of investing, because that's part of the protection, is recognizing the one that scares me the most is the one I can't see. I can see this pin. I can see, like, we're going to have liquidity problems in the bond market someday. That could be it.
Yep.
But it could very well be the thing we never thought of.
Yeah.
So learning as much as you can on what you can see, and then learning how to deal with the things that you can't see, which is really the risk management. You just have to assume that you can't see everything.
Yeah.
And to be prepared for it.
Well, and I operate under that assumption all the time now. In fact, I used to really follow headline news like I was going to have the knowledge ahead of time.
Oh, yeah.
I used to pay big bucks just to get the news wire before that was readily available.
Oh, yeah.
And it finally occurred to me that everything that's known or possibly knowable gets priced into the chart. So I just watch the chart, and I don't even bother so much with the headline news, because half the time it's just they're retrofitting a headline to fit what the market did,
retracement
or to
support.
find a reason why it sold, et cetera, et cetera. Every once in a while, the news is actionable. Like, that news is actionable, and that could mean this, and so on and so forth.
Yeah.
But at the end of the day, the response for me is going to be the same, and I kind of have it where I think of like portfolio defense on levels. Like, okay, if I get this first signal, I put a little insurance on. If I get a deeper signal, I'm going to add, to that position. And again, I don't have to predict. My goal is to not overreact, because the average market dips like 3 to 5%. Every once in a while, you get a 10% dip. And then every once a decade or so, you get a doozy, which is like, 30% or more.
Okay, let's end this way. So the summary is Fitch doesn't believe it's risk-free anymore. And it's still not bad. I mean, AA plus is still investment grade. When do you go from what's junk? When do you go from investment grade to junk?
So it's higher than you'd think. You go into the Bs, and you're in junk status, which
high yield.
High yield, yeah.
It's all about marketing.
Yeah, high yield.
Title.
These are high yield.
Title is everything. Don't call it junk. It's the high yield market.
Yield.
But isn't it interesting that even those scores, like if I just told someone that, I've got a double B rating, somebody would think that was
good.
Pretty good.
Hey, if you look
but
at
all
my,
of a sudden,
if you look at my college transcripts, anything above a C plus keeps you eligible to play ball. You can play if you're above a C plus.
There you go. And so Andy, C plus.
Yeah, C plus, C plus. Well, actually, no, it was kind of a C plus. We might have fallen down a couple times here. You got enough basketball classes to keep you. I had enough athletic classes to
you needed to
offset
average.
my chemistry.
You needed to average.
Yeah, you couldn't fail, but you could,
Gotcha. Yeah.
I can't remember. It's been 30 years ago.
Well, isn't that the saying that A students teach and B students work for C students?
Robert's book, his book was, this is such a great title of a book, why A students work for C students and B students work for the government. Isn't that fantastic?
That's funny.
Why A students work why A students work for C students and why B students
there's
work
truth
for
to that. The non-conformists are the entrepreneurs.
100%.
That's where the entrepreneurial spirit comes from. It's like, I'm not going to do your thing. I'm going to do my thing.
That's totally me.
And there you go.
Yeah, I'm not going to do all this. I'm looking at these guys. We used to. I had a buddy of mine. We would lie a little bit in that we'd come in there to be a test. We'd studied a little for the test, maybe not as much as we should. But we'd get all these A students, and we'd make them crazy, because I'd say, we'd walk in and like, dude, there's a quiz today? Like as if we didn't know. We'd play dumb. There's a quiz today? And he goes, I guess. I go, man, I guess we shouldn't have gone to Wendover last night. These A students are like, you guys suck. We're studying out here. And they think we went to Wendover, So
they walk out and tell them how
for those that
dumb
don't
the
know,
basketball
that's the
players
for
are.
those that don't know, Wendover's about 2 hours, and it's like right on the
Nearest
border.
casino.
Nearest casino to this particular region.
Yeah. So anyway, it was fun. All right, finishing up then. So it's not risk free. There's no such thing as risk free. Probably never was. U.S. Treasuries, risk free or not risk free?
U.S. Treasuries not risk free, but considered risk-free in the markets still.
Okay, but I'm talking your opinion.
No, I would say not risk-free. I mean, the U.S. dollar's only been in existence for a short time period, and to say that something is truly risk-free means that it's guaranteed to be here forever, and there's just no such guarantees. However, let me say that I think the path to prosperity is still in asset ownership. You just have to get in that mindset. The Warren Buffett adage, I think, is brilliant, which is he's a little more sad whenever he is selling assets or not finding anything to buy, and he's happy as can be when he's finding great bargains at great value, at great prices. And that's still the proper mindset. So sometimes this stuff can sound scary. Sometimes it can turn you off to the markets, which you say, well, there's too much risk there. I can't get involved. It's actually quite the opposite, that we should be more nervous about them printing enormous amounts of money, devaluing your currency, And the way for you to fight back is to learn how to own assets, how to protect yourself when markets are turbulent, volatility's high. That's the key to success, my opinion.
Boy, I should have let him go last.
Yeah, probably. That's a
Let's end
strong
it there.
note to finish
Noah,
on.
risk-free, not risk-free.
Well, there is no such thing as risk-free. And I really liked what you said in our last time we got together, which is that risk is correlated to control. Yeah. One of the things I don't particularly like about bonds is they have a maturity date and you're kind of stuck in it for a while. And my ability to limit or offset that risk is less than if I own stocks. And so for me, it comes down to how well do you know the asset class. For the real estate investors out there, they might know how to address the risk better than I do. And it's learning how to control your risk, and also to not just think about the fear. With every great catastrophe, that just creates opportunity. And it's just having that right mindset. You got to have that right mindset. And again, it's not the investment, it's the investor.
Maybe I should have let you go last, because that's what I was going to say. Is we can argue whether an asset is risky or less risky or more risky, but an investor is an investor. Like, I wouldn't have my mom do the stuff I do. No way.
Yeah.
Because it's really investor centered. We get caught up in looking at the asset rather than the person that is actually doing.
Well, that's a great way to analyze it, is if you had 3 investors and they all made a 10% positive return, are they all equally as good? And you'd say no. Who had the least amount of risk and still generated that return? So that's the key. They have more shallow drawdowns. They don't risk as much and they still generate that profitability. That's creating alpha. That's creating outperformance, right? And so when the downturn hits, if all 3 of them made 10%, but 2 of them give it all back and then some, but the other guy is protected, he keeps his profit. And that's the key.
Great takeaways. Buy assets. That's your way to defend.
Yep.
Be smart. Don't be learning what monetary policy is after the fact. Learn what a beta weight is. Learn what a delta hedge is. Learn what delta neutral is. And to Noah's point, don't be a risky investor, which is an ignorant investor or a volatile investor or a person with the wrong temperament. If you're ignorant and have a poor temperament, that's not a good recipe for doing well.
Well, and I don't think the average person's temperament comes out of the package with the right temperament for investing. It's something you learn over time. I think it's something that comes from...
I think you learn by getting your face kicked in.
You do. You learn from mistakes. Mistakes are great teachers.
Or other people's mistakes.
Other people's mistakes, experience.
Notice who said that. Like, you learn by getting your face kicked in. And Corey's like, I learned from watching Andy get his face kicked in. Yeah. Watching others.
You can't avoid it if you just learn from others first.
Yeah. Yes. Well, it's less painful, I assure you.
Some of us are more stubborn than that. So that's why Corey's a great investor. He's got a great temperament. So I thank you guys. Great takeaways from at least I got a lot out of this. I hope our listeners did as well. With that, we'll close the show. You've been listening to the Cash Flow Academy podcast. Hope you enjoyed our discussion on, the credit rating drops and what does that entail, chinks in the armor, things like that. We're just grateful to have you listen. We're so excited that we've grown like we have. So continue to tell your friends, and we'll see you next time.